Well, investors learned this morning that producer prices in the U.S., a key measure of so-called wholesale inflation, fell in March by the most since the beginning of the pandemic. The news has spurred investor hopes again that the Fed may be very close to the end of an historic rate tightening cycle. To talk about it further, we're joined now by Tom Essaye. He's president of Sevens Report Research. Tom, thanks a lot for joining us. Let's talk about that economic news of this morning and that softer than expected PPI number. Does it, in fact, legitimize hopes in the market that the Fed is very, very close now to the peak?
Good morning, everyone. Thank you very much for having me on. I think it does incrementally confirm that we are at or near a peak in rate hikes. But as is always the case with markets, what they always want to know, what are you doing for me next? So now focus has moved not from the peak in rate hikes, but to when do rate cuts begin? And that's really what's helped stocks rally globally over the past couple of weeks. But it remains very uncertain if we will see rate cuts later in the year.
I want to bring up a quote from today's edition of your newsletter, the Sevens Report. You take note of the massive gap between market expectations for 2 to 3 rate cuts by year end and the Fed's insistence, of course, that there will be no rate cuts by year end. And then you go on to say we should all be prepared for a 5% air pocket in stocks if it becomes apparent the Fed is not doing what the market expects. That's an interesting comment. Tell us more about your view there. Again, the issue here is the dichotomy between interest rate expectations in the market and what the Fed has signaled over and over again.
Exactly. Really, since the rate hike cycle began in early 2022, we've seen this very strange dynamic where not just the Fed, global central banks, Bank of Canada as well, have said we are going to raise rates faster and higher than the market thinks. And throughout 2022, that is exactly what happened. And it caused disappointment and lower stock and bond prices. Now here we are in 2023, the same dynamic exists. We have central banks who are saying, look, we have raised rates a lot and we are going to pause soon, but we are not even thinking about cutting rates yet. And the market has priced in 2 to 3 rate cuts by December. So we're talking about, in 8 months that we will be 50 to 75 basis points lower. That is why stocks and bonds have rallied. And the problem is, if the Fed does not make good on those expectations, then we are going to give this entire rally right back.
And so what's going to happen? I mean, that is a pretty rapid deterioration of the U.S. economy that the market is effectively pricing in.
I agree. I'm having trouble with the logic here that I'm more optimistic on stocks because the economy will be so bad that the Fed will cut interest rates. As I said in my report last week, that's kind of like a kid hoping that they get into a car accident so he doesn't have to turn in his homework. Sure, it accomplishes the goal, but it's a pretty steep price to pay. So I think that people should be cautious here. I'm happy stocks and bonds are higher. I hope it lasts. I'm just trying to point out that the underlying assumption isn't exactly backed by facts yet.
Our stock market's overvalued. One thing we talked about earlier in the program with another guest is Goldman Sachs out with a report suggesting that investor positioning and fund flows suggest the S&P 500 should be about 6% lower than it is right now.
Yes, I think it is based on any sort of traditional valuation metric. Because again, now we have to remember, stocks are discount mechanisms. What that means is they are pricing in the future, not what's happening right now. And stock markets think that in the future, rates will be lower, and as such, stocks will be more attractive. That is underpinning this entire rally. And again, while I hope that stocks can stay up, that's just a very big assumption, and it flies in the face not just of what the Fed is saying, but what every major central bank is saying. Even Tiff Macklem yesterday pushed back directly on the market by saying, look, you're pricing in these rate cuts. We just don't see that happening right now.
Let's talk about commodities. What's your view on commodities given the economic uncertainties that exist around the world?
I think you really have to look and break commodities into 2 baskets. Your industrials, things like copper, aluminum, more base metals, even to a point oil. There's obviously a supply side issue there with what Saudi Arabia and OPEC Plus are doing, but then also the precious metals. And I think that the outlook for the precious metals is becoming more and more positive. especially as we look at dollar weakness and the fact that, look, we will get rate cuts at some point in time because the global economy will slow. Whether it comes in December of 2023 or June of 2024, we don't know yet. But that's going to be a positive environment for the precious metals. I think that they're setting up for potentially a substantial run.
And a substantial run in gold would take it well into record high territory. That's where you see it going, is it?
Yes, I think so. I think it'll take time, certainly. But gold is acting, we say this in trading, it's acting the best that I've seen it act in years. And I mean going back to sort of the early 2010s during the last gold bull market. It's not a done deal yet, but it's certainly looking good.
Okay, why don't we finish with the trio of bank earnings that we're going to get tomorrow. I've asked a couple of guests what they would be interested in hearing from the CEOs when they provide some guidance and commentary on conference calls. What would you be listening for from the likes of JP Morgan Chase, Wells Fargo, and Citi?
My focus is going to be on loan demand. Right, because we obviously know that margins for banks are very compressed given what's happening with the yield curve, but especially following the uncertainty of the regional bank failures here in the United States. I want to know if they've seen a drop in loan demand, not just from people, but also from commercial entities as well. If they have, I think that's an additional headwind on the economy, and it would make me a bit more cautious.